All right, good afternoon. Good afternoon to all my friends in Australia. Welcome to Gemini's Intro to Crypto webinar. My name is Jeremy Ng, and I'm the Managing Director for Gemini APAC. And together here with me is my colleague, Sunil, who is our Senior Principal in our Business Development team. So together, we are very excited to have the opportunity to share with you this afternoon about the fundamentals of cryptocurrencies, and we'll talk about what is happening today and also the future of cryptocurrencies. So quick introduction of who we are. So Gemini is a licensed cryptocurrency exchange and custodian. We're founded in 2014 by Cameron and Tyler Winklevoss, and we are a secured and regulated platform. And we are operating in more than 50 countries in the world and servicing clients across US, Europe, and Asia Pacific. We've got more than 550 staff already at present, and we're operating across 7 different offices in the US, in Europe, in UK, Germany, Spain, and here in Singapore is our headquarters for Asia, and soon we could be in Australia as well. Now, as I mentioned, today we've got a pretty tight schedule. We're going to talk about what is blockchain and going into the fundamentals of that. We'll give a bit of highlight, what is happening today in the crypto land, from a regulatory, institutional adoption, and also obviously want to talk about what is the future, use cases of crypto, and obviously, very important to talk about how you can get involved as well as an investor. And we'll leave some time for Q&A. So without further ado, I'll leave the kickoff to Sunil.
Hey, thanks, Jeremy. Good afternoon, everyone from sunny Singapore. Before we jump onto the content, I'd like to get a feel of where you guys are with crypto. How many of you are already interested or invested in crypto? There's a poll coming up. If you can just look at that, that'd be great. Yeah, it'll give us a feel of where you guys stand. Okay, I hope you guys are answering that right now. I'm going to give you a few more seconds to answer the poll. Do you see the poll, guys? It'd be great to just get a feel of where you guys are at with crypto. Okay, the poll's closing now. And I see the results. And so it looks like quite a few of you, 58% already own cryptocurrency, which is great. So it's a very informed audience. And then we have 17% who are just not into it yet. And hopefully after this seminar, we kind of convince you to take a bit of a dive into it, and 25% are considering it. So that's fantastic. So let's dive straight into what is crypto, what is blockchain cryptocurrency. Shall we go to slide 6? Cryptocurrency is just one kind of blockchain. So what exactly is blockchain? On slide 7, we take that up. Next slide. So to properly understand blockchains, we need to start by briefly discussing a concept in cryptography called the hashing function. It's some kind of complicated math, but we're not going to get into its depth. Hashing functions are an essential part of cybersecurity and cryptocurrency protocols such as Bitcoin. It is a method of cryptography that converts any form of data into a unique string of unreadable text, like the one that I've shown in the picture. Any piece of data can be hashed, no matter what its size or type. Hashing is an extremely difficult function to reverse, and it's basically a one-way function. That means you can convert plain text to hash text, but you cannot do it the other way around. Hashing is therefore crucial to maintaining the cryptographic integrity of blockchains. Let me share that with an example. I know this is a little bit technical. Stay with me, guys. On slide 8. Next slide. So in this example, we have a list of names. Now, if you hashed a text file with these 4 names, you would get a value, let's say, that starts with 2C754. This is exactly how a hashed function actually, so it's some kind of code basically that comes out on the right hand side. But if you change or add or remove even one character of those names, the whole value changes to a totally different value. So if you added, say, for example, Daisy in this example, you would get a new value like 2D891 or something like that. So any other computer that hashes this same file, which has these 4 names, will get the same unique value 2C754 instead of something else. So basically, you cannot tamper, you cannot add, you cannot change anything because it changes the hash function completely. Slide number 9, which is the next slide. Here you can see 3 different batches of data, each producing different hashes. These batches of data aren't connected to each other right now. So let's say, for example, if John made a transaction at 1 p.m., he's grouped in batch 1 with all the others that made the transaction at the same time. Batch 2 are transactions made, say, 10 minutes later, and so on. So how is the hashing function used in blockchain, which is on next slide? We'll just show how this is connected. So you can think of hashing function as the chain or connector in a blockchain, linking one block of data to another. So each batch of data that you see in the picture that is added to the network needs to include the hashed value of the previous batch. Hashed value is also a sum of all the data in a particular batch or block of data. So I'm using block or batch interchangeably, right? So basically, any batch of data, of which basically in blockchain we call it block of data. So when you take this hashed value and add it to the next batch, you're essentially stacking the data one on top of the other. So basically you have the first set of data and then you have the second set of data and so on, right? So that's how the blockchain is. So the simplest way to think about blockchain is it's just a chain of blocks or a chain of interconnected data. And the chain is the hashed function and the blocks as data. So the latest blockchain would comprise of all the transactions that have been made on the blockchain. It also means that someone else cannot insert any data in the middle of this chain or tamper it, because the hash function completely changes if you tamper with this data. And every other computer already has that ledger which references this hash. And so you cannot really play around with that. The rules that we discussed form the foundation of a blockchain protocol. This is not a new technology. Blockchains were originally devised in 1991, but over the past decade, they have found the most prolific use in cryptocurrency. Next slide. Now that we have a sense of what blockchain is, let's talk a little bit about mining. The mining process is basically that you get a bunch of computer hardware together and they solve complex math computations. Each time a problem is solved, they confirm a block or a group of transactions. Mining is also how more Bitcoin is created. So there's only ever going to be 21 million Bitcoins. So it's a deflationary currency in that sense. Mining allows new Bitcoin to be created to up to that limit of 21 million Bitcoins. We won't hit that limit until 2140. But in the meantime, we are creating small new pieces of Bitcoins every 10 minutes or so. 10 minutes or so, because every block almost gets processed in 10 minutes. Slide number 12, let's talk about how mining works in detail. A cryptocurrency transaction is just the structured data like a paper check. Remember the old times, if you guys have, maybe if you, some of you guys would remember that, we used to actually write checks to banks. So it basically, the cryptocurrency transaction is just something similar. It has something like to, from, amount, and stuff like that. It's just like a paper check, but it's in its digital form. So how do these blocks of data actually get added to the blockchain? Every time a computer broadcasts a transaction data, it is transmitted to a network to join a list of transactions waiting to be put into a block. So remember, blocks get processed every, let's say, 10 minutes. And so there would be something called a memory pool that's already in existence by the time the next block comes on. Next slide. So a miner with specialized machines, sorry, A miner with specialized machines can attempt to produce or mine these blocks of transactions. To mine a block, they have to solve a mathematical puzzle via a lot of guesswork, which requires a lot of computing power. So the first miner to hash all these values together to produce a hash with a certain number of leading zeros has essentially found the next valid block. So in this example, if our protocol rules were to find a hash with one leading zero, using the number 4 as a random number allows us to produce what is considered the next valid block. So basically you start guessing with a lot of numbers, and then the first guy who hits upon the right combination that gives you the right kind of code starting with leading zeros basically is the person or the network or computer that's allowed to mine the next valid block. And then he in turn gets rewarded in the form of some more Bitcoins. So once these transactions are found in a block, they are removed from the memory pool. This process is mining of Bitcoin transactions. And this also allows users not to know who's actually processing the transaction. And the processing is random, meaning the network that finds the right combination of code is eventually gets the right to mine the next block of transactions. Next slide. So the hashing process can take a lot of guesses. It's intentionally hard to find a hash with a lot of leading zeros. The number of leading zeros required can be referred to as the difficulty of the network. So remember, computing power is going up, so the difficulty level also starts to go up because we actually want, like the protocol actually wants that every 10 minutes, there is a block is processed every 10 minutes. When people say there's this term that called proof of work, which is in reference to this process of finding a hash that meets the rules. You've proven that you've done the work required to produce a valid addition to the blockchain. The process of getting everyone involved to agree on what block should be added to the chain is now referred as consensus. So next slide. So running a computer, can we go to the next slide? So running a computer to mine blocks costs a ton of energy and money. So why would people want to do it? Like we mentioned previously, miners get block rewards when they successfully validate the block, and the Bitcoin is granted as a reward to the miner. So if I decided to run a computer that helps produce the next block, then I'm rewarded with the new Bitcoin minted to pay me for providing that service to the network or the people. There are other terms called halving. Halving is in reference to reducing these rewards by half. So it's basically just related to Bitcoin protocol, which states that over time, the rewards will decrease. And this happens every 4 years, that the reward in that currency decreases every 4 years. You may have also heard something called proof of stake. So there's this proof of work, which is like this all kinds of guesswork that a computer network needs to do and consumes a lot of power. But now there is this alternative mechanism called proof of stake. Instead of proving that you've done the work to produce a hash, everyone in the network or the miners in the network take turn to produce blocks to add to the blockchain, and their additions are expected to meet the rules. Now, in order to mine blocks in a proof of stake system, the miner actually needs to escrow a large balance of reward currency. Think of it as the miner is giving a guarantee or putting up a guarantee to basically say that I'm going to stick to the rules of the game. And for whatever reason, if they do not stick to the rules, then the escrow of these funds can be slashed and they will lose the stake they put forth to participate. So it's basically that staking. It's a guarantee that the miners will behave, and if they do not behave, then their funds can be slashed. So all the other block producers actually check whether the block produce has any problems, and if there is a problem found, then the miner who processes the transaction, their stake will be slashed, and it will be rewarded to the person who actually identifies the problem. So it's kind of self-balancing mechanism. It's quite beautiful. The one good thing about proof of stake is it's a promising new mechanism, and it consumes so much less energy. It's about 99.95% less energy post-merger for the Ethereum Foundation that's basically been testing this proof of stake workflow since December of last year, and it's expected to roll out sometime later in this year. So next slide, please. Now that we've gone through the blockchain 101s, let's get some terms right. Bitcoin is just one kind of cryptocurrency. Bitcoin is also the most popular cryptocurrency, but there are other cryptocurrencies. We'll talk about this, and we'll talk about the second most popular one, Ethereum, in just a bit. There are other types of blockchains too. There can be blockchains that track ownership of assets or property as they're transferred from, say, a building developer to a buyer, and then to another buyer, and so on. And there are even blockchains that track intellectual property, who owns the rights to a song or a piece of art, such as NFT. Remember, the concept that we're discussing apply to almost every other cryptocurrency. So, we talked about Bitcoin, but, all these things actually, most of them would apply to other cryptocurrencies. Blockchain is simply defined as a decentralized distributed ledger technology that records the provenance of a digital asset. That's it, right? That's in its simplest form. Next slide. So what are the features of Bitcoin as an asset? Bitcoin is a cryptocurrency invented in 2008 by an unknown person. He was named Satoshi Nakamoto, but no one knows who he is. I'm sure 58% of you who own it definitely know this. Bitcoin is also a currency just like US dollar or Sing dollars, with just some unique characteristics. So unlike the money that you're used to, Bitcoin was built for the internet and for the whole world to use. Now, when I say for the whole world to use, imagine in Australia, you can only use Aussie dollar as the legal as the currency for doing transactions. And in Singapore, we only do like Sing dollars, and in the US, you go US dollars. But Bitcoin was created such that it could just become one global currency. Of course, there are hindrances to actually getting that adoption, but that's the whole idea, that one single currency. Why do I ever need to change from Aussie dollar to Sing dollar to US dollar? I mean, why do I even have to go to banks? You could just have one currency. Why not? So that's the entire idea. Bitcoin is a decentralized digital currency without a central bank that can be sent from user to user on a network without the need of intermediaries. And that is really powerful. Next slide. So we talked about halving earlier, right? Roughly every 4 years, the block reward given to Bitcoin miners for processing transactions is cut in half. This acts like a deflationary mechanism. This can cause some implications for investors who believe the scarcity drives prices. On the right-hand side of this Bitcoin, you can see the amount of Bitcoin is basically capped, and it's kind of coming off, it's tapering off, and in 2140, it will reach the max level. Whereas look at US dollars, how much the Federal Reserve is printing just in the last 10 years. And you can see the money supply in US dollar, that is just money being printed. So of course, if you think about Bitcoin's relative value versus US dollar, you would see, Bitcoin should have more value because there's so much more US dollar in the world. I mean, just simple as that. You can still have inflation in Bitcoin, but it'll never take you by surprise. In the next 19 years, it is estimated that it'll be about 12% more Bitcoins available. So in the world of Bitcoin, nobody has the ability to make 2 trillion Bitcoins out of nowhere, which, of course, in the case of US dollar or other currencies, we know that central banks have been busy printing a lot of their own currencies. Next slide. So we'll talk a little bit about Ethereum. So Ethereum and Ether were created in 2014, and essentially Ethereum is a new programming language built on top of blockchain technology. Now, Ethereum is a big step forward in blockchain and cryptocurrency space, as it creates programmable money, or what we call smart contracts. I'll go into smart contracts in just a moment. So one of the main things people build on the Ethereum network are token-powered networks. Now, these tokens are called ERC20 tokens. So Ether is the token of Ethereum, but ERC20 tokens, which were built on Ethereum, have their own different yet similar blockchains, and those have unique use cases. So So that's the distinction between ERC20 and Ether. Slide 20, the next slide, please. So the Bitcoin blockchain is built for sending money between people. Ethereum can do that as well, but it was built to run whole computer programs inside the blockchain. Now, these programs are called smart contracts, and the easiest way to understand why they are so innovative is, let's just go with an example. Let's say your firm agreed to invest in a startup if they met their year's revenue goals. You could set up a smart contract that would automatically release the payment if the goal was met, without the need to involve your bank or lawyers. So basically disintermediation, right? And it's just automatic, no ifs and buts there. The smart contract would monitor the startup's progress and automatically send the funds to their wallet once the goal was met. That's just one example of what can be done with smart contracts. You can also use smart contracts to track who owns some piece of property, for example, or collectibles or artwork. In fact, there is an emerging digital art market in NFTs, which are blockchain powered to ascribe provenance to an asset. And excitingly, Gemini has a big investment, and we have this business called Nifty Gateway that if you guys know about NFTs, you would know about Nifty Gateway as well. Another common use case to build a whole new cryptocurrency right into a smart contract is, think about you're renting with another landlord, and basically you need to pay him every month. And these kind of contracts can come about where you just program program money such that on the first of every month, till such time certain conditions are met, you are going to pay your landlord on the first of the month, and that just happens automatically. So there can be so many use cases. Of course, this doesn't exist today, but this is just the vision of future. There can be so many utilities around smart contracts. X condition is met, Y is done, and money is released. So basically, those kind of things. I mean, you could think of utility bills. You could think of there's a bunch of stuff that you could think of, and that's basically the utility of blockchains that's emerging in the smart contracts world. Next slide. So one interesting thing that ERC20 tokens have been used for is to create stablecoins. Stablecoins are tokens with a value pegged to a fiat currency like the US dollar. A lot of people use these for trading to achieve liquidity without off-ramping fees. When I say off-ramping, it's basically going back to fiat currencies. But there's many other use cases for this. Countries are starting to talk about their digital versions as well. Venezuela, China, Russia. I do believe that one day in the future, the US dollars will also be tokenized, and you will be able to have a way to digitally interacting with dollars without needing to involve the existing financial system or the legacy financial system. Hey guys, so the technical part is over, finally. So I will pass on my time to Jeremy to give us a lot more interesting insights into the crypto world today and the way forward, of course.
Thank you very much, Anil. So yeah, I mean, it's really interesting, and I think going through the building blocks of blockchain and cryptocurrencies, hopefully it will help you that these terms will no longer be as foreign as before, and you can even explain it to your family and friends. So next, I'd like to spend about maybe up to 15 minutes on the practical aspect of cryptocurrency as an asset class. I'll start off with the crypto landscape, how it has kind of evolved over the last few years, and then about the latest development in terms of the adoption by the investment community. So I'll start off with regulations. So many developed markets such as US, Canada, UK, Singapore, Japan, South Korea, they do have actually very proper regulatory framework to regulate cryptocurrency trading. And here in Australia, the regulation of cryptocurrency is still quite nascent. And currently, the Australian law does not treat cryptocurrency as money. And the Senate has also not made a firm decision on how it wants to regulate crypto. But the good thing is the government has not shied away from trying to learn more and try to firm up the legal parameters for crypto. So for example, about a year ago, last year in August, the framework, like a sandbox that tests a broader range of financial services for the next 2 years. And it is intended to provide better support innovation in the crypto sector. And subsequently, ASIC also engaged with overseas regulators like UKFCA to sign the Enhanced Cooperation Agreement, which allows the two regulators to exchange information and conduct joint policy work. And ASIC is also working in tandem with other parties like in Singapore, Canada, Hong Kong, and Indonesia to facilitate cross-sharing of information on market trends, innovation, competition in the sector. And earlier this year, the Senate appointed a select committee to scope out the opportunities and risks in the digital asset and crypto sector, and specifically studying regulatory frameworks in other countries, such as Singapore, to understand better. And the committee is due to submit a report of their findings and recommendation, sometime towards the end of next month. And I think this webinar came in just in time to kind of keep you informed of the changing regulatory environment, especially within Australia. And I certainly encourage all of you to keep abreast of the news regarding all this. Now, the increase in regulatory oversight and participation from the Australian government actually sends a very positive message that cryptocurrencies is starting to be viewed as a maturing asset class and requires obviously some form of oversight, which is really positive on two counts, right? One, it will protect investors, especially the general retail. And number two, it would also increase institutional adoption. I mean, for those of you who have invested back in the last bull run, you will remember, right, how Bitcoin has kind of gone from 3,000 to 20,000 in the space of 6 months at the end of 2017. And then, quickly falling down, into a 2-year bear market, which was obviously really painful. And at that time, the market is basically filled mostly with retail investors and very little institutional participation. And even JP Morgan's CEO, Jamie Dimon, once called Bitcoin a fraud. But obviously, JP Morgan is now, clearly very involved in this space and even offering some of their private wealth clients some access to crypto funds. So the market has changed quite a bit and evolved. And as we head to 2022, and there's huge increase in participation from institutions like high net worth, family offices, hedge funds like Portfolio Jones, managers like BlackRock, and even corporate treasuries that we read about, MicroStrategy and Tesla. So yeah, I'd like to talk a little bit more about the institutional adoption. Visa and MasterCard have announced the plans to incorporate digital currencies into their pipeline. And sorry.
Sorry, guys. I think there's some bad audio on Jeremy's side. So if you give us just a second, we'll try and fix it. Give us just a second, please. Yeah, we're just trying to fix this.
Hi, can you hear me now?
Yes, that's better.
Okay, sorry about that. I think some Wi-Fi issue. Okay, now I'll continue on this part on increased in institutional adoption. So I kind of mentioned a bit earlier that major players like Visa and MasterCard, they've announced, right, to incorporate digital currencies into their pipeline. And Tesla obviously had purchased 1.5 billion in Bitcoin earlier this year. And we've also looked across the S&P 5, S&P. Sorry about that. And we see, am I back on?
Yeah.
Okay. So we also see that crypto indices that has been established on S&P Dow Jones, and you look at Morgan Stanley, is also becoming one of the first big banks to offer the high net worth individuals access to Bitcoin funds. And then later on, we read about Goldman Sachs partnering with Galaxy Digital to offer Bitcoin futures trading for the institutional clients. So I think there's a lot going on, and obviously, pretty excited to see that El Salvador has adopted Bitcoin as a legal tender and becoming the first country to do so. And obviously, that move prompted Panama to also introduce a bill to regulate crypto payments in the country as well. So I think the last 12 months has been a very fundamental move in cryptocurrency space. Moving not just retail investors, but really a lot of institutional adoption. And I think the impact of that is that we're creating a much more healthier marketplace. You look at volatility of Bitcoin, for example, compared to 2 years ago, it's actually dropped by quite a fair bit. And that's also because there's less speculative traders. I mean, obviously there are still retail traders that are trading, on a speculative terms, but with more and more institutional investors coming in, and institutions, they spend a lot of time researching before they invest and before they allocate. So they have a much stronger hands and more holding power. Next slide, please. So what is the main reason that Bitcoin, for example, being the largest and the earliest cryptocurrency that's been catching on the attention of people like MicroStrategy or Tesla? I think the bulk of it, like what Sunil has mentioned before, is the money supply has increased tremendously since the pandemic started. The amount of money printing by the U.S. central bank has surpassed what they have printed prior to that. Sorry, you don't know what it's going to get. Wait a second.
Sorry, guys, there's some issues with Jeremy's Wi-Fi. Jeremy, we can't hear you. You are on mute. No, the audio is still not great. Jeremy, I suggest you just come to my room and just do it from here.
Actually, you know what? I'll remove my head. Is it okay now?
Yeah.
Okay. Apologies. So yes, we talk about money supply, and we talk about the amount of increase in money supply ever since the pandemic, has actually trumped the amount of money printing prior to the pandemic. And Bitcoin is in a lot of different areas quite similar to gold, but actually a better version of gold. If you look at the scarcity factor, Bitcoin has a maximum of 21 million to be printed or to be mined, whereas gold is still increasing in supply of, say, about 2 to 3% per year. And you talk about storage costs, it's almost costing nothing to hold your Bitcoin, either in your own private wallet or in an exchange like Gemini. Whereas gold, you're going to pay the bank to hold it in the vault. And portability, obviously, is difficult to carry bars of gold bars, right? But with a thumb drive, it literally can carry unlimited number of Bitcoins you want. And divisibility, I think, is something that's very important. For Bitcoin, you can own a fraction of a Bitcoin in up to 8 decimal places. And I think that's really what it means for the people. It's a money for people. It kind of empowers the individual again. So again, maybe we can also take a look at how people are valuing Bitcoin. So there are different ways. Well, first of all, Gemini is an exchange. We are not a financial advisor. Next slide, please. And we can share with you what we're seeing in the marketplace. Can we have next slide? So for example, large investment banks like JP Morgan and Citibank, they have the analysts, they kind of come up with some kind of price target. JP Morgan has a price target of 146,000. But Citibank has an even more bullish expectation of 318,000. The Winklevoss Capital, the founder of Gemini, they basically look at in my previous slide, gold versus Bitcoin. And if you look at the market cap of gold right now is at about 11 trillion compared to Bitcoin, which is only about 2 billion. So there's easily a 10 times upside, if Bitcoin indeed is a better version of gold. So they come up with a 500,000 long-term price target. And there's another model called a stock to flow model, which typically is used on commodities such as gold, silver, and platinum. And the stock to flow ratio is basically to evaluate the current stock of a commodity, i.e. the total amount that's currently available, against the flow of new production, i.e. the amount that's going to be mined in this specific year. And if you look at a chart on the bottom right-hand corner, it actually has a very high correlation, the Bitcoin price versus the stock to flow model. And that model is basically modeling, up to 1 million. Obviously, these are all different price targets. We don't know when that will happen, but just to kind of give you a sense how the market or how the institutional investors are looking at this as an asset class. So what is the future for crypto? I think the possibilities is really vast. There's a lot of day-to-day, modern-day usage. For example, government is trying to adopt in their central bank digital currencies to make their money more digital, more efficient. And with the use of smart contract, you could also potentially track the deed to your house or your diploma, your certificate, your identity, or even your medical records. And then with smart contract, we can also potentially replace some Grab or Airbnb, whereby buyer and seller can essentially use a protocol to engage each other without a centralized organization. So NFT, non-fungible tokens, is really interesting, for ownership of digital assets such as arts, collectibles, and even like virtual real estate. Now, I think the more important question is for you, how do you get involved? So we're very pleased to, maybe you can go to the next slide. Yeah, we're pleased to share with you that, over in Australia, a Gemini platform is available. And we allow you to have an unlimited amount of Australian dollars of deposit and withdrawals, and there's no charge. In terms of signing up, it's very simple. You just have to use one ID and we can verify you and you can be set up. And we offer a mobile application. And for those of you who are a little bit more actively trading, we also have a platform called Active Trader that you're able to look at better charting, you're able to place limit orders, stop limits, and the transaction fees is also a lot more competitive. And we also offer a wallet for you, which is free of charge. For those of you who wanted, even higher security, you can opt to choose Gemini Custodian, which is our cold storage facilities. Now, just a reminder, even though one Bitcoin is worth about $50,000 right now, but you can always buy in a fraction. You can invest as little as $5 worth. So in summary, cryptocurrencies is a new form of money that's decentralized, that's not controlled by any central authority. And Bitcoin and Ethereum obviously are the most popular ones, but there are clearly a lot more others that are up and coming. And you can get your crypto, you can store crypto in an exchange like Gemini. And the next is, we have a special giveaway for all of you here, that if you visit, you can scan the barcode, the QR code here, you sign up and you can receive $10 worth of Bitcoin after you make your first trade of after $100. So this sign up bonus is only available for a very limited amount of period. So do register now. And for further learning, we actually offer a, on our webpage, Cryptopedia. It's essentially a free crypto educational platform that is proprietary for Gemini, and is authored by a lot of thought leaders and some of the most prominent and innovative crypto projects. So you can learn everything you need to learn. You can learn about blockchain, you can learn about DeFi, you can learn about different tokens, the technology and the use cases. And also we have Gemini Earn, which will record all the previous crypto webinars, including this one, will be recorded as well. So I definitely encourage you to do your own research, because the world of crypto is constantly evolving and there are always new things to learn about. And we have a Telegram channel as well. We'll share on the chat room that you can join us to be updated with the latest news that we have. So with that, we're going to take some questions here.
Yeah. So thanks, Jeremy, for the insights into how the crypto world looks like and what the future is looking like as well, and the way people can participate with the Gemini network. So I have a question here from Christopher Sim asking about volatility in the crypto market. So let me take a dig at that. So one thing, the way crypto markets have evolved, it has been initial retail participation, which it's also, there's another thing which is a feature of the crypto market is still developing, and there's still limited amount of research. The sources of information are very, very diverse as well. There's institutional participation that's just starting, which basically means that people with deep pockets, be it asset managers, be it ETFs, be it sovereign wealth funds, they're just starting to look at this market. And it's just a combination of it being a new market. There's still understanding that's developing. It's more retail participation, which is kind of and the availability of information, and that kind of causes volatility when some kind of new news kind of breaks out in the market. Also, the market is segmented a little bit right now, given the number of platforms, and the linkage between platforms is the linkage between platforms is also a bit limited. So you need institutional participation eventually to curb volatility. So that's really our take on why there is so much volatility in this market. Okay, so we have a few other questions. So I have a question around, we have a question around what happens to Bitcoin after 2140. So, clearly Bitcoin, the max number of Bitcoins are going to be minted up to 2140, and then there's no more Bitcoins that the miners will get. So essentially, it could take different shapes or forms. One, of course, is that the miners will have to depend on just the fees that users are going to pay for the mining rewards. That's one form. The other is that right now the complexity of the algos or the mathematical problem that we talked about, that keeps going up over time. That could reduce because the miners have less incentive to mine Bitcoins, and so you don't need this kind of sophisticated machines. And then basically the complexity of those mathematical problems actually reduces, and that might not be a bad thing given there are environmental considerations on how much computing power is being used in Bitcoin. So it could take different shapes or forms. I think it'll basically, the debate will start sometime in 10 years. I think up to then no one's going to ask this question too much, but it's a very good question for sure. I also have a question from Nathan Curtis. He's talking about, if can he move in from, just give me a second. Let me scroll to the question. So can Gemini account holders move freely between geopolitical jurisdictions? Can a client set up Gemini account in Singapore and then move to US smoothly, or will they be subjected to additional requirements and restrictions? So, I mean, from Singapore to US, if you wanted to change the status, and that should be quite smooth because we have clients in both jurisdictions. Between what we offer to our US clients and to our Singapore clients, there might be a little bit of a difference in terms of offerings. Sometimes you have just different things being offered depending on the legal opinion that we get. So we operate in 51 countries, but mostly it should be a very smooth transition. If you have any specific questions, you can obviously write into a customer service and they should be able to help you out.
Yeah, maybe I'll take one question from Emmanuel. Does Gemini offer services to institutional investors? The answer is yes. So we actually have a team that covers institutional investors, and Sunil is part of that team. And we have product offerings that are slightly different from the general retail products. So we have a whole prime service stack that includes OTC execution, where we have traders that are sitting across the 3 different time zones in US, in Europe, and also here in Asia that facilitate OTC execution. We also have services that allow our institutional investors to trade derivatives, for example, options and futures. And we also have a lending and financing platform where institutional investors can trade with the financing that's provided by Gemini, and along with some other different services that's white glove and handholding. So yes, we do. We are actually very big in this market. So for example, if you look across the first ever exchange traded Bitcoin ETF that was listed on Toronto Stock Exchange, Gemini was selected to be the sole digital asset custodian. And subsequently, the next 5 ETFs that were listed in Toronto, they all use Gemini as the digital asset custodian. So I think that kind of goes to show that we are very active in the institutional market in addition to the retail space. So you can pick the next one, Sunil.
Yeah. So I have one question around what are the ASEAN countries that Gemini is looking to expand into. So we currently have our focus on pretty much all of ASEAN, right? So we are looking at the markets like Thailand, Malaysia, Indonesia, and Philippines as well. And we are looking at what's being what are the requirements for each of these jurisdictions. And yeah, but we definitely have plans to expand in the greater ASEAN region. So
yeah, there's one question on DeFi asking what is our opinion on DeFi and can it be adopted by the masses to replace some of the existing financial system? A very good question. I think DeFi space is one area that Gemini is actually very excited in, and you can see that we have been very supportive in terms of rolling out ERC20 tokens that is linked to the DeFi space. So to put things in perspective, DeFi means decentralized finance, and within all the decentralized finance applications that's built on top of the Ethereum blockchain, the current total value that's being locked up has surpassed $150 billion US. And we look at just 12 months ago, that number was less than $1 billion. It was like a few hundred million. So in the whole grand scheme of things, 150 billion, might not be that big, compared to the overall credit market right now. But I think the growth has been exponential, has been very healthy. And if you look across, just a couple of months ago, back in May, when the market experienced a huge drawdown, there isn't a single default in any of the DeFi protocol. It kind of goes to show that the protocol itself has managed the collateral well, that none of the assets has been impaired. So I think that is very positive. And I personally is very bullish on the DeFi space. I'm not giving any financial advice, but we think that, at some point, it will start to begin to provide as an alternative financial system. Now, will it overtake the existing financial system within the next 1 year, 2 years? Maybe not. There's still a lot of work to be done. But I believe that over time, especially when there is more proper regulatory framework around it, the users can ensure the proper KYC and AML. I do see a very huge opportunity within the DeFi space.
Thanks, Jeremy. Let me take the next question. So there's a question around what signs should you look for that indicate that you should invest in that particular cryptocurrency. So to me, it's eventually the utility of a particular, blockchain or crypto. So, what we have to look at is eventually how much use case does a particular blockchain protocol and its cryptocurrency eventually has, and that would lead to increased adoption of that particular cryptocurrency. And eventually prices are moved by demand supply, right? So eventually, if there are more buyers, then there are sellers, and the utility is increasing of that cryptocurrency, that would basically be the case, then the prices tend to go up. And that's, to me, at very basic, what you should be looking at, the utility of that particular currency. Now we have another question around our custody services for institutional clients. So, Gemini is like the way we see ourselves is, we see ourselves as security first. So trust is our product. That's how we think internally within Gemini. And essentially what we've built is a world-class custody service. We are one of the most regulated exchanges across the crypto space. So just in the US, so our primary regulator is New York State DFS, Department of Financial Services, but we also licensed in the UK under UK FCA, but we also have to have licenses in each of the US states, because in the US, crypto is a state subject, not a federal subject. And so we have a lot of regulators looking at it at us at all points in time. The second is that we are a fiduciary. We have a fiduciary duty as a custodian towards our clients. And essentially what we've tried to build on the custody side is what we are positioned as the same as let's say Bank of New York Mellon or State Street is in the traditional finance space. That's what we model ourselves in the crypto space. And so just to give you an example, some of our servers are located in the same space where NASDAQ servers are. We basically have a multi-sig technology for our custody. We have the highest level of security for our custody solutions. I mean, if you want to have a dialogue around our custody solution, just reach out to us. Just write into us, and we definitely be able to take you through more details around our custody. One thing I would mention here is that we have a partnership with State Street, which is again one of the largest global custodian for traditional assets. So kind of gives you a sense of how well we are regarded in this space in the custody solution.
Yeah, I'd like to take one question also related to that. The question from Ruben: with digital wallet in Gemini, how safe would it be? And will Gemini restore the amount of digital wallet when the system is down or hackers steal our crypto assets in this digital wallet? Very good question. First of all, I think that the Gemini cold storage infrastructure is probably one of the best in the world. We use the highest security level rating of hardware security modules called HSM to build our cold storage infrastructure. And on top of that, we have the industry's largest insurance coverage of about 290 million within our wallet infrastructure. So, just to put things in perspective, Gemini has never been hacked successfully. I'm sure there are hackers that try to hack our custody, but it has never been successfully hacked. And we don't foresee that in the future as well. So if in the event that there is a hack that's been successful, we do have insurance coverage to provide coverage for our clients. So I think that's one question. And I think there's another question that asks about, what is Gemini's USP for institutional clients and also other custodian services, the likes of 9day or Coinbase. We are the only platform in the world that has achieved the SOC 1 Type 2, SOC 2 Type 2 for both our custodian and exchange. I think that underpins the infrastructure and also the processes that we have in place that meets all the highest and most stringent requirements through this Deloitte examination. So I think that's really where we stand out. And also we are one of the few platforms that offers one of the widest spectrum, not just trading as an exchange and custody, but we also offer OTC products, I mentioned earlier, lending, options, derivatives, and even offering a credit card that pays instant crypto reward in the US. Hopefully we can roll that out in Asia sometime soon, but we're going to roll that out in the US first. So I think both in terms of the certifications that we have passed and also the wide product spectrum, I think that's really where we stand out against our competitors.
So I'll take one question from Christian Claudio. How is Gemini preparing for all the regulations, lawsuits, and such happening with other similar crypto interest yielding platforms? So let me just start by saying this, that the way Gemini operates is we think about regulations first. As I said earlier, we are probably the most regulated platform, across the globe, and we want to be. Our founders have gone on record to say that they would embrace regulations, and that's exactly where we stand. We do not want, just even at the cost of, having some loss of business sometimes, we are conservative in how we step forward and how we read regulations. So we, of course, from that perspective, we hope that we have read the regulations in the right manner, and we've gone with the conservative view, and we do not necessarily have a lot of issues there. So, that's really where we stand. Of course, that doesn't mean that there won't be lawsuits, but hopefully, we would have basically taken care to make sure that we have been within the boundaries of whatever regulations are there. Now, of course, the regulations are still developing as we go along, and we would definitely look to adhere to whatever regulations that our regulators specify for the crypto space.
Well, time flies and we are almost at the hour. Well, first of all, thank you very much for coming and joining us in this webinar. And we hope that you've enjoyed this session and found something useful. Now, remember to follow us on the socials. We're on Instagram, Twitter, Telegram, Facebook, and do scan this crypto giveaway to receive your $10 of Bitcoin. In any case, stay safe, have a good day. I'll see you again soon. Goodbye.
Thanks very much.